Forget literally everything you've been told about spamming your pitch deck to 300 investors. If you are doing that, you have already lost the game before you've even stepped onto the field. With the right investor, your odds of securing funding might hover around 25%. But with the wrong one, it is exactly zero. And worse, there is a 99% chance you have one specific slide in your deck right now that is instantly, irreversibly destroying your credibility the second it hits the screen. This breakdown of deconstructing the pitch beyond the slide deck can also be found on our website, Knowlator.com. Let's get into it. If you are an entrepreneur stepping into the fundraising arena today, the rules of engagement are completely different from what prevailing startup folklore would have you believe. You're walking into a room where the deck is heavily stacked, attention spans are microscopic, and the margin for error is essentially non-existent. We need to completely deconstruct how you think about pitching, starting right from your very first outreach strategy. Most founders, even highly experienced ones, operate under the fatal assumption that fundraising is simply a numbers game. They scrape a list of 1,000 venture capitalists off some database, fire off a generic, templated email blast, and assume that if they cast a wide enough net, eventually someone is bound to say yes. It is the ultimate spray and pray methodology, and it is fundamentally broken. Treating all investors as if they are this monolith with the exact same mandates is the absolute fastest route to universal rejection. An experienced investor will tell you that the sheer volume of unfiltered, completely irrelevant applications is staggering. Roughly half of all the pitch decks that land in an inbox are thrown out immediately, gone within 10 seconds. Not because the ideas are bad, but because they are entirely out of scope. For example, a founder might pitch a massive offshore wind farm project to a micro fund that explicitly only backs mobile gaming apps. It is like trying to sell a heavy-duty industrial crane to a neighborhood bakery and then getting frustrated when nobody wants a test drive. Now you might think, sure, I might be slightly outside their normal focus, but my idea is a billion-dollar opportunity. Surely they'll make an exception for a great deal. That is a very dangerous misconception. It demonstrates a complete lack of understanding of how venture funds are actually structured. It comes down to strict, non-negotiable legal mandates. Venture capitalists, or VCs, are generally not investing their own personal money. They are investing on behalf of their limited partners, or LPs. These are university endowments, pension funds, and family offices. When a VC raises a fund, they sign legally binding agreements with those LPs stating exactly how and where that money will be deployed. If a fund is legally bound to only invest in the United States and Canada, and a brilliant startup from South America applies, it goes straight into the rejection pile, instantly. If they invested, they would be breaching their fiduciary duty. You also have to watch out for the corporate structure trap. A lot of early-stage founders set up their companies as LLCs because it's easier and cheaper early on. That makes sense when you're bootstrapping. But many venture funds can only invest in a C Corp for specific tax reasons demanded by their LPs. If you apply as an LLC, that is an automatic rejection. Your corporate structure acts as a mechanical filtering mechanism. But let's assume you are savvy. You have a C Corp, you are in the right geography, and you've targeted a fund in your specific sector. There is another massive trap waiting right behind it. It's called the too early trap. A lot of founders operate under the delusion that formal investors are in the business of funding ideas or beautiful PowerPoint presentations of the future. They are not. Formal investors do not fund ideas. They fund execution. Pillar 3 is the origin story, but it comes with a strict constraint. It must be under 1 minute. Briefly explain why you started this company. This taps into the fundamental psychology of trust. Startups are brutally difficult, and a concise origin story proves you have a deep personal connection to the problem. It signals obsession. Ambition gets you started, but obsession carries you through the grueling tedium of scaling. The investor is looking for the grit to protect their capital, so keep it brief. I experienced this pain point in my last job. Existing solutions cost us millions, so I built a 10x better way. Done. Empathy, authority, and obsession in under 60 seconds. So, your deck is flawless. But having a great deck doesn't mean you know how to pitch. Surviving the room without freezing up requires rigorous preparation. When you're standing in a boardroom, your cortisol levels will spike. Adrenaline pumps. You will likely experience a mild amygdala hijack, where higher-level cognitive functions start to shut down. You literally forget how to speak. Your training is the exhaustive mastery of your go-to-market strategy. Your diet is your financial plan. You must rehearse until it's so ingrained that you can execute the routine on pure muscle memory. A massive part of that is knowing your numbers inside and out. Apply the anti-story rule. If an investor interrupts and asks what your exact break-even revenue is, do not tell a story. Do not philosophize about billing cycles. Just say the exact number. Answering a sharp quantitative question with a meandering narrative signals weakness and evasiveness. Know your year 1 through 3 annual recurring revenue, your break-even point, the cash required to reach it, and your headcount at each stage. Cold. You also need to apply the divide by 2 timing rule. If you have a 1-hour time slot, your presentation should take exactly 30 minutes to deliver. The environment is unpredictable. Investors arrive late, cables won't connect, and if the pitch is going well, they will interrupt you with heavy Q&A. If you pack 55 minutes into a 60-minute slot, a 5-minute interruption destroys your pacing. Leave half the time for the Q&A, where the actual decision is made. And always bring physical backups. A dead projector is a live-fire test of your operational redundancy. Always bring flash drives and paper copies. Assume the Wi-Fi will fail. Finally, let's talk about team dynamics. If you have 2 co-founders, shouldn't you both share the spotlight? No. This is a fatal mistake driven by ego. 2 founders pitching together is actually a massive red flag. Adjusting to different speaking cadences breaks the narrative flow, but more importantly, it signals an inability to delegate. It means 2 founders are wasting their most valuable resource, time, doing a one-person job. Let one founder pitch, let the other build the business. Only bring team members who add tangible value, like a VP of engineering, to answer deep technical questions during Q&A. But they sit quietly until called upon. Before we summarize how to actually apply all of this and win the room, just a quick reminder that you can find more knowledge translated at Knowlator.com. To bring it all together, surviving the high-stakes environment of venture capital pitching comes down to absolute precision and earned conviction. You have to understand that investors are bound by the math of the power law and strict legal mandates. You must instantly hook them in the first 60 seconds by clearly defining your 10x improvement, proving your specific market opportunity through undeniable bottom-up traction rather than theoretical fluff, and anchoring your credibility with a 1-minute origin story. You must prepare like an elite athlete, knowing your financial metrics cold so you can deliver exact numbers without hiding behind a story. Build in massive buffers for your time, engineer redundancy protocols with physical backups, and leave your ego at the door by having a single, unified voice command the room. And that is pitch content translated. I'm your host, and this is Knowlator, your knowledge translator. For more breakdowns of elite startup strategies, head over to Knowlator.com.